Okay, we're going to do M1110 and M1111 together because they pretty much relate to the same information. M1110 says, Sturdy Stone Tools, Inc. announced 100% stock dividend. Determine the impact, increase, decrease, or no change of this dividend on the following. And then M1111 says, determine the impact then of a stock split. Instead of doing 100% stock dividend, they do a 2-for-1 stock split. So let's take the stock dividend first. A stock dividend can come in two sizes, large or small, right? The large stock dividend is greater than 20 to 25%, and the small stock dividend is below 20 to 25%. The reason why we care whether or not it's small or large depends on the journal entries that we make. So if it's large, we make one certain type of journal entry. If it's small, we make another one. The journal entry that we make, if it's a large stock dividend, is we simply debit retained earnings, and we credit common stock. This is our large stock dividend, and it's for par value of the stock that we issue. So the number of stocks that we issue times the par value, right? This is the large stock dividend. If it was a small stock dividend, it would be for the market value. So we'd still credit common stock for the par value, but then we'd credit APIC for the additional above par value, right? But that's if it's a small stock dividend. This one is obviously greater than 20 to 25%. It's 100% stock dividend. Therefore, we're doing large. So here's the journal entry that we're going to affect. It doesn't even matter if we have numbers. We can see right here what accounts we affect, either retained earnings and common stock. These are the two accounts we affect. So if we go down the line, this problem asks us to identify the change in various different line items on the financial statements. The point of this problem is really to illustrate the effect of this journal entry. What is the actual effect, okay? So I'm going to erase this, but let's keep this in mind as we go down the list. You can see that assets have absolutely no change. Why? Because we don't affect assets with retained earnings and we don't affect assets with common stock. So there's no change on assets from doing a stock dividend. That's one of the benefits of the stock dividends and the fact that we are not have to actually pay out cash, right? We still keep liquidity in that sense, okay? Liabilities. No change in liabilities. Again, common stock is not a liability, that's part of stockholders' equity. Retained earnings is not a part of a liability, it's part of stockholders' equity, so there's no change here. Common stock, obviously, common stock goes up. Why? Because we credited common stock. Total stockholders' equity, again, there's no change. Why? This might take a little bit more explanation, but you can see that if you're debiting retained earnings, which is part of stockholders' equity is going down when we debit retained earnings, and we're crediting common stock, and common stock is going up for stockholders' equity, the net effect is zero. So that's why there's no change. Market value is a decrease. This is another reason why a company might issue a stock dividend. The market is going to react to the increased number of shares that are now in the public, right? So we've increased the number of shares that are now going out. The market will react accordingly, perhaps not immediately, but most of the time pretty quickly. It'll react and decrease that price, at least for a temporary time period, and then hopefully will rise back up. But lowering the market value allows more people to be interested or reasonably interested in the fact that they could now afford it to buy the stock. If you have a $1,000 stock price or you have a $2,000 stock price or something like that, only a certain number of people can afford X amount of shares or a block of shares, right? If you drop the price lower, if the market value becomes lower but there's more shares out there, then more people can buy it, okay? So this will lower the market value because they'll react accordingly. Now, let's differentiate this stock dividend from a stock split because they're not the same. With the stock split, there is no journal entry. So there's not actually any journal entry that we do. Instead, we make a note. Essentially what a stock split does is it takes all the stock that's outstanding, recalls it, and then issues new stock back out and changes the par value. So if you had a par value of $1 and you do a 2-for-1 stock split, you now have a par value of 50 cents, but you have double the amount of stock out there. Does that make sense? So this is a stock split. With a stock split, assets have no change. Why do they have no change? Because there's no journal entry. Liabilities, same thing, no change. Common stock, same thing, no change. But par value decreases, number of shares increases, right? Total stockholders' equity, no change. Market value still goes down. Why? It reacts accordingly just like the stock dividend. More shares are now outstanding, so the market value per share is going to decrease, at least for a temporary time period, okay? So those are the main differences that we're trying to look at between these accounts, between stock dividend and stock split. Main thing I want you to know, over here we have a journal entry, over here we don't have a journal entry, but it still affects par value and the number of shares outstanding. Market value will react accordingly for both types of events. If you have any questions on this, please feel free to let me know.